Well, we're telling folks that now continues to be a fantastic time to be able to get invested in fixed income. You know, it's pretty fascinating. This is not the largest we've seen in terms of global fixed income markets, but right now there is more income available in global fixed income markets than we've ever seen before. So it's a fantastic time for fixed income.
Translation in shorthand, you're saying that the rally we saw that started, when was it, back in July, that can keep going, that's got legs?
We think it has legs because the yield and the income is still available. So, you know, yields are a little bit off of the recent highs, but we still think it's a fantastic time to be an investor in global fixed income markets.
Okay. Could yields move back up again if any one of a number of supply chain dislocations that are waiting in the wings from the tariffs, and a lot depends on the election outcome, of course, to the instability in the Middle East, really start to have a profound effect on inflation?
There's certainly risks that are out there to the outlook, but the ones that you're mentioning, I think the market is relatively comfortable with because they can digest and discount some of those risks. These are not things that are going to necessarily surprise the market per se, because they're things that the markets have been really grappling with for a number of years. And when you look at the potential for supply disruptions, it is I think less of a risk than what the global economy has been dealing with the last couple of years. So there are certainly risks that are out there, but I think the market is ready for those.
Talk about the benchmark and the U.S., of course. When I take a look at, Fed funds after that jumbo 50 cut, what are we at 475.5 or so, right?
Yeah.
You've got two's the short end at 360. That's still a bit of a gap. What does that tell you? And what does the shape of the curve tell you now?
Yeah, so the shape of the curve, it has been pretty fascinating because you are starting to get some steepening in the curve, some normalization in the curve, most notably in 2's 10s, but even the 530 curve is now moving further into a positive slope. We think that is a good thing. And when you look at the overall trajectory of monetary policy easing, we think this is also supportive because it's not in reaction to a growth shock. It's in reaction to positive disinflationary trends. So you see, even though the Fed did end up cutting 50 basis points, they're still on a 25 basis point trajectory moving forward. That's a good thing for the market.
Got to ask you, you're not worried about the labor market? Unemployment, what are we at? 4.2, 4.3. We had an economist that we talked to fairly regularly, David Rosenberg, and I'm not sure if you follow him or not, right? Saying that, look, we should be taking a look at the supply side, right? We should be looking at the demand side. The fact that, look, companies are just simply not hiring. It's got nothing to do with immigration.
Yeah, so I think that this is an area where it is probably not as concerning as it normally would when you see the unemployment rate tick up from the low 3s into the low 4s like we've seen, and it is because there's been a slowdown in new hiring, but not a rapid increase in layoffs, and I think that is a positive. That's quite a bit of a different labor market dynamic. It indicates more balance between supply and demand.
So I got to ask you, Rosie is and has always been sort of a big bear, right? By his reckoning, right, Fed funds should be at the end of the cycle, this easing cycle, where they were at the end of 2019. 175, which, if you work the math backwards, that's 300 basis points or 12 by 25. If they go at 25, I don't know. Is that too bearish?
We think that's too bearish. Yeah. We're expecting a Fed funds rate that probably ends up closer to 3%. And we talked about some of these things just now. There are concerns about inflation more broadly and kind of supply dynamics. Globally, you have higher fiscal deficits. It is quite possible that you have a higher neutral rate this time around. And so we would anticipate that the prior cycle, that's actually the anomaly, the Fed funds rate being below kind of 2%. That's the one that sticks out and is unusual. We would anticipate this time it's going to be closer to 3%.